What is Ltcg? Why is there a lot of buzz around on this particular tax? Our Finance Minister Arun Jaitley introduced the much talked about long-term capital gains tax, long-term capital gains Ltcg on sale of listed securities on gains of over rupees 1 lakh. The move surprised everyone as most analysts were factoring in a change in definition of long-term to 2 or 3 years from 1 year. Jaitley introduced a long-term capital gains tax of 10% if the gains exceeded rupees 1 lakh without allowing the benefit of indexation. However, all gains till 31st January 2018 will be grandfathered and short-term capital gains remains unchanged at 15%. For example, if the equity share is purchased 6 months before 31st January 2018 at rupees 100 and the highest price quoted on 31st Jan is rupees 120, there will be no tax on the sale if the stock is sold after 1 year. However, any gains in excess of rupees 20 earned after 31st Jan 2018 will be taxed at 10% if this share is sold after 31st July 2018. The next doubt that arises in the mind is, when is the direct tax, that is, when is the Ltcg has to be paid? When is this tax payable? Since it's a direct tax proposal, it will normally be applicable for the assessment year FY 19-20, financial year FY 18-19. In other words, the LT capital gains of over rupees 1 lakh made for the year FY 18-19 will be liable to tax at 10%. What is the relevance of the cutoff date of 31st Jan 2018? The Finance Minister, has proposed grandfathering of LT capital gains up to 31st Jan 2018. Any incremental LT capital gains after that will be counted as LT capital gains for the new tax. So what happens to my tax liability if I sell stocks starting today, held for more than a year? As for LT capital gains made in financial year 17-18, that is sale up to 31st March 2018, it appears there is no tax. However, any sale made after 1st April 2018 will be liable to the new Ltcg tax. One needs to segregate this LT capital gain into two parts. Part 1 is LT capital gains made up to 31st Jan 2018. This will be the highest price of the stock on 31st Jan 2018 minus the cost of acquiring stocks. Part 2 is the LT capital gains made after 31st Jan 2018. This will be sale price minus highest price of the stock on 31st Jan 2018. While part 1 will be exempt, it is the part 2 that will be accessed as LT capital gains. It can also be a capital loss for tax. Tax on this will be computed at the rate of 10% plus cess of 3% only if it exceeds rupees 1 lakh. So what is the right strategy now on equity investments? Any equity investor wishing to reduce the LT capital gains tax liability can sell stocks starting today till 31st March 2018 and incur zero tax provided the holding period is more than a year. However, one can continue to buy equity shares without any hesitation. Any future sales after 31st March 2018 has to be judiciously chosen to minimize the tax liability. Assuming equity investments yield a return of 15% every year, an investment of rupees 6.66 lakhs each year will rise to rupees 7.66 lakhs in a year, and gains booked thereof will be tax-free. Even if the gains exceed 15% to say 25%, the LT gains tax will be rupees 6,667 only. A small illustration of the chart which is displayed, you can see that Ltcg shares sold on or before 31st 3 2018, it is nil. Shares purchased before 31 1 2018 and sold after 31 3 2018, purchases, that is, the purchase price would be 100. The highest price as on 31 1 2018, let's see, it's 125. The sale price is 140. For that, the applicability, you can see that the total Ltcg would be 40. Exempt Ltcg will be 25. Taxable Ltcg of rupees 15 is applicable, that is tax at 10%, 1.5. Shares purchased after 1/2/2018 held for 12 months, tax would be at 10%. So this is a small illustration. Hope this gives you a clear picture of how an Ltcg functions. Thank you.